Today I'm teaching you the concept of top-down analysis, or some people like to call it multiple time frame analysis. Top-down analysis is basically understanding the charts from the higher time frames to the lower time frames. There are three simple steps for top-down analysis, and the first is finding the direction of the trend. And to do that, you will need to open up a monthly chart. Now, personally, what I like to do is just mark areas of resistance and support. We can also mark the monthly time frames trend just to establish what is currently going on. So the direction of the trend has been established. Let's continue with the top-down analysis, and we will need the weekly time frame. And as we can see, the candlesticks are making new highs every single time. It's a little stepping ladder. There we go, going up, going up. So we have established now that the monthly time frame is going up and the weekly time frame is also going up. Now, in different situations, you may want to mark another area of trend line on the weekly, maybe a mid-range zone, but in this case we don't have one, and we can pretty much use the support of the monthly time frame as the weekly as well. So since the weekly time frame didn't offer as much price action as we hoped, let's head over to the daily time frame and scan through the charts. And wouldn't you know it, we have identified a nice little trend towards the upside on the daily as well. We can also mark an area of support just over here, or the previous area of sensitivity, little consolidation, had a push, now an exhaustion back, likely another push towards the upside is around the corner. And that's all you do with the top-down analysis at the first glance. So the monthly time frame was the direction of a trend. Weekly and daily time frames were measuring the behavior, how it actually moves and what price action is it giving us. In this case, there's not many chart patterns. Maybe this one over here, there was a double top, nice little break, went towards the upside and reached the take profit level. So now if we continue with the top-down analysis, we can have a look at the 4-hour time frame. 4-hour and the hourly time frame typically are my entry time frames as a swing trader. If your trading style is scalping or quick day trading, you want to carry on this process through 4-hour, 1 hour to 15 minutes to 5 to 1 minute to get as much intricate data as possible. This way you'll have the biggest chance for success when you're trading, whether you're trading Forex, crypto, stocks, it doesn't matter. It works the same ways with all financial markets. So what I like to do on the 4-hour time frame is simply look at candlestick price action. So nice rejection of this area zone and a bullish engulfing candlestick to go with it. This confirms there could be huge bullish pressure coming forward very soon. So we need to be, on top of our game. So if we look at long position, we could potentially enter this trade for 106 pips. So we could potentially enter this trade, maybe aim for this previous area of resistance, but it wouldn't give us the best risk to reward ratio. So what we want to do now is actually add a few indicators to help us with our top-down analysis decision making. So what we can do is add a few moving averages to help our decision making. So 200, 50 and 20 moving averages seem like a great choice to me. So once we add the moving averages, we can see a lot more information now. If we just zoom in a little bit, we can see that it's currently not breaking the 20 moving average. And although we had a bullish engulfing candlestick, we still need a further confirmation to see whether it's gonna continue moving up or not. We can actually have a look at the hourly time frame now and see what's going on. And it has not broken the 50 just yet. It has bounced off the 200. There is a strong rejection and likely it's gonna break the 50. But since it hasn't yet, maybe it's a good idea to just wait an hour or two just to see whether we're gonna get that candlestick close we are looking for. So if we take a look, 3, 4 hours, 5 hours in, we managed to break this area of sensitivity, right? Previous area zone was over here, was broken with a bullish engulfing candlestick. Hourly time frame 50 moving average has now been broken. We could potentially enter the trade just over here, move our stop loss around here. 4-hour time frame, we want to be aiming for this previous area top, so it wouldn't give you the best risk to reward, but this is okay for the first take profit. If it continues moving up, you move stop loss to entry, you make it risk free, and your potential gain would be around here, which is 373 pips. So instantly it gives you a better risk reward as well. 2.84 is much better than whatever it was, but this is the way I trade. The first initial risk to reward doesn't really matter. As long as it continues moving up, then you can adjust and take over. What I also like to do with my top down analysis to add the most accuracy as possible is use pivot points, monthly pivot points to be exact. So once we add them in, we can see the decision making is going to be much different. So if we take a look at the monthly, it's currently crossing our monthly pivot area. Weekly, the same thing. As we can see, it bounced off many times before, currently breaking through. Daily has already broken that pivot line. Look at this. Push, exhaustion, back towards the pivot line, back towards our area of sensitivity. It actually bounced off the 20 moving average. Our stop loss is covering just in case it continues moving down. It's likely gonna bounce off the 20 moving average on the daily time frame, and then the 4-hour time frame. This is where the pivot line is. Currently, it broke out, bullish engulfing candlestick. Likely is gonna move up over here to retest this area. This is where we take our first take profit, and depending how the market moves, we can continue trading towards the previous area of resistance or the new monthly resistance pivot line that we have just drawn. So as we can see, the top down analysis is very logical. We are trading when the market has broken the pivot line. We are looking at the candlestick confirmations, and let's just see what actually happened with this trade. So it went towards the upside, pulled down, and it continues to move up and actually follows the moving averages very nicely. We would have been around 225 pips in profit. Now, if you ask me, 1.72 risk to reward ratio wasn't bad at all. You can obviously close off your trading positions in case it breaks, the 20 and 50 moving averages on the 4-hour time frame, just to manage your risk. Maybe make it like this, then it straight away gives you a better risk to reward as well. It really depends how you trade and how you manage. This is a different lesson for a different day, but the top down analysis I do works most of the time, and I recommend everyone uses it, whether you like price action, whether you like smart money. Making money online this way becomes quite easy as long as you're patient with it. Here's another example of top down analysis. We use the same concept on our USD Swiss franc trade from our VIP group. Again, you first want to start with a monthly time frame and you want to find a chart pattern. In this case, we have a triple top just over here. The calculated target profit has not yet been reached, and we also have our monthly pivot line marked. If we take a look at our weekly time frame, we can see that it has never broken the 50 moving average or our monthly pivot line. This is a great sign for the market to turn around. Now, if we take a look at the daily, although it has broken the 200 moving average, we are still sitting on that strong level of price action, and I am expecting a lot of sell orders just around here. And if we take a look at the 4-hour time frame, there's a huge spike in power for the bulls, and I like to call this the rubber band effect. After it spikes like that, what is it, around 120 pips, it should be heading towards the downside at some point. For a retracement, simply meaning where it goes up, it has to stabilize and come back down, and a great place to do that is, of course, the monthly area of pivot resistance, right? So although the moving averages on the 4-hourly are trending towards the upside, it doesn't matter because the rubber band effect will likely take over. So a push, and likely we're going to see a lot of sellers over here, and we should be pushing the market further down. Now, to confirm this trade entry, you want to use the relative strength index, and as we can see, it's currently being overbought. Monthly pivot line is also in favor for the trade. We can enter the trade short, and this is what we did with our VAP trade. And as we can see, if we extend it, let's see what happened with this trade. It dropped towards the downside nicely, actually managed to break the moving averages, and it reached around 120 pips in around a week's time, just because we were trading in the area zone where there was a lot of selling pressure building up. And this is the main reason you want to do top-down analysis, because you will find high accuracy trades without the need to be searching for them. Once you draw everything out, all you will need is patience.